9 trading days to first notice day, 59,000 contracts still open, 294 million ounces of paper silver sitting in the open position column, refusing to roll off the way the banks and mainstream analysts promised it would. And today, U.S. markets are closed for President's Day. Shanghai is closed until February 24th for Lunar New Year, which means the single largest physical price anchor in the precious metals market is offline. The Eastern buyers who have been absorbing every single Western paper raid, the physical demand that has been acting as a floor every time the manipulation attempts to run the price down, gone for 8 straight trading days. And the people who benefit most from that absence know exactly what they have in their hands right now. An 8-day window with no Chinese buying pressure, no Shanghai price discovery, reduced overall market participation, and a COMEX silver registered inventory sitting at 90 million ounces against 294 million ounces of open interest, with first notice day 9 days away. The price smash that everyone who understands this market has been expecting has not fully materialized yet, and that fact alone tells you more about the true state of physical supply and demand than any mainstream financial headline you will read this week. Something is different this time. The mechanics are screaming it, and if you understand what you are actually looking at, the picture forming right now is either the setup for the greatest manipulation event in modern precious metals history, or the moment where that manipulation finally runs out of road. Before we go any further into the mechanics of what is actually happening, hit that like button right now if you want to see more analysis that goes deeper than the sanitized narrative. Subscribe to this channel and press the notification bell because the window we are discussing is moving fast and you need real-time awareness as this unfolds. Share this with anyone you know who holds physical silver or has exposure to precious metals futures, because what happens in the next 9 days could determine the trajectory of these markets for months. Now let us get into exactly what the data is showing and why the institutions do not want you to understand it. Let us start with the current snapshot because understanding where we are right now is the foundation for understanding what comes next. Silver Western spot price is sitting at $76. COMEX futures are at $76. Now look at what Shanghai was showing before the holiday closure. Shanghai spot at $86. Shanghai futures at $88. That is a $10 premium that Eastern physical markets were paying above Western paper prices before the shutdown began. A $10 structural premium is not noise. It is not a temporary aberration. It is the physical market sending a continuous signal that Eastern buyers value silver at a fundamentally different and dramatically higher price than the paper contracts being traded in London and New York. Gold Western spot is sitting just below $5,000, slipping under the psychologically significant level that the paper market has been unable to sustain cleanly. March silver open interest dropped slightly at the end of the week to 58,770 contracts as 43% of position holders rolled forward to the May contract. Here's the critical number that the mainstream analysis is completely missing. 57% stayed. With 9 days remaining before first notice day, with every rolling mechanism available and every traditional pressure applied to force position closure, 57% of the open interest in March silver has not moved. That is a profound divergence from historical rollover behavior patterns, and it tells you something very specific about what a significant portion of the market is positioning for. Here's what most people do not understand about COMEX delivery mechanics and why the current numbers are genuinely unprecedented in the context of where we are in the physical supply cycle. Historical data analyzing 10 full years of silver futures contracts shows that silver averaged 4.9% of open interest actually standing for physical delivery. The most recent elevated numbers show 13.55% delivery demand, which is already extreme by historical standards, though the average across recent months is closer to 10%. If we apply a 10% delivery demand scenario to the current 294 million ounces of March open interest, that produces 29 million ounces demanding physical delivery. COMEX registered inventory at 90 million ounces can theoretically handle that. But apply the elevated recent average of 13%, and you get 38 million ounces demanded. Apply a 20% delivery scenario, which is within the realm of possibility given the structural dynamics at play, and you get 59 million ounces demanding physical silver from an inventory of 90 million. Those historical delivery averages were calculated during normal market environments, not during the 6th consecutive year of structural silver deficit, not during a period when Eastern buyers are paying $10 premiums over Western paper prices for physical metal, not during a moment when India's silver imports just jumped 129%, outpacing gold imports as higher prices reshape the trade flows, not during a period when China's metals trading volume exploded 86% month over month in January, with combined aluminum, copper, nickel, and tin futures reaching 78 million lots, 5 times the average monthly volume of the first 11 months of 2025. The historical baseline is not applicable to current conditions. The people who apply it without adjusting for current structural dynamics are either not paying attention or are paid to make you not pay attention. Now let us talk about January 30th and why understanding exactly what happened that day is essential for understanding the risk and the opportunity embedded in the current setup. A Swiss expert with deep derivatives market experience called January 30th the biggest $100 billion fraud in modern financial history. That is not hyperbole from a retail investor who lost money. That is the assessment of someone who understands the mechanics of how the crash was executed. Silver plunged over 30% in a single day from peaks above $120 down to the 70s. The move started right after the London fixing at 1512 Central European time. Then a $26 drop happened inside 180 minutes. JP Morgan closed massive short positions exactly at the bottom of the move, having already paid $900 million in fines for silver spoofing in previous regulatory actions. COMEX ignored its own circuit breakers in thin Friday trading conditions. 1.83 billion ounces of paper silver traded on COMEX that single day. To put that in complete perspective, that number represents more than 2 full years of total global silver mine production traded as paper contracts in a single session. 0 physical silver moved. Not 1 ounce changed hands in the physical market as a result of the carnage that hit paper prices. And here is the tell that exposes the entire mechanism for what it actually is. While COMEX silver was crashing 30%, Shanghai silver premiums exploded to 40% above Western spot prices. The physical market in the East was sending a direct, real-time signal that the paper price crash had absolutely nothing to do with physical supply or demand reality. Eastern buyers were not selling. They were aggressively bidding for physical at premium prices while Western paper was being systematically destroyed. China's regulatory response to the crash was immediate and decisive. Chinese authorities cracked down hard on naked short positions, banned specific traders involved in the manipulation, and opened 180 cases against market participants who exploited the mechanics. China did exactly what a functioning regulator is supposed to do when it detects market manipulation. The contrast with Western regulatory action, which was essentially non-existent despite the obvious anomalies in the data, tells you everything you need to know about who benefits from the current architecture of the paper, precious metals markets, and who those markets were designed to serve. What happened to the Chinese silver fund investors who got trapped in the crash? A Chinese fund manager unveiled a compensation plan addressing widespread losses from the country's sole silver futures fund, targeting investors who submitted redemption orders from January 30th through February 2nd, the period when losses were magnified by an extraordinary valuation adjustment mechanism. Investors whose incremental loss beyond the capped 17% daily limit was under 1,000 yuan will receive full compensation, accounting for more than 90% of those who redeemed. This situation exposed something critically important. The Shanghai Futures Exchange. 17% daily price limits were designed to protect investors. But during extreme volatility, they actually impeded the fund's ability to execute exit trades. And traders with advanced information about how this revaluation mechanism would work exploited it systematically. They knew how the mechanical adjustment would force prices, and they positioned short in Western paper markets to profit from the predictable cascade. Then they covered those shorts at the absolute bottom while retail investors absorbed the losses. Bloomberg's behavior during the sell-off is worth examining in detail because it illustrates precisely how financial media functions as a weapon in these moments rather than as a source of honest reporting. During the worst selling periods, Bloomberg published multiple articles emphasizing the scale of the declines. Headlines focused on big drops, no buyers left, and crazy swings with almost no liquidity. The bulk of these stories were published precisely when prices were falling hardest in early February. On February 12th, Bloomberg ran a specific story claiming Russia might return to using US dollars. Right after that article was published, silver dropped rapidly from $85 to $74 in a matter of hours. Traders documented the headline timing and noted that the story scared participants and caused algorithmic selling reactions at a moment perfectly designed to benefit anyone positioned short. This pattern of large mainstream financial media outlets, specifically Bloomberg and Reuters, being used to time algorithmic reactions in thin markets has been documented repeatedly across multiple previous manipulation events. Understanding this pattern is not paranoia, it is pattern recognition applied to observable data. Now let us look at the macro context that makes the current 8-day window so significant in terms of both risk and opportunity. Dollar short positioning just hit a 14-year extreme according to the latest sentiment survey data. Short bets against the US dollar are currently at their highest level since January 2012, the earliest point in the available data set. Fund managers have dropped their dollar exposure below last April's lows. Concerns about Federal Reserve independence eased but completely failed to lift dollar demand or improve sentiment toward US dollar-denominated assets. Respondents are citing further deterioration in the labor market as the key downside risk to the dollar going forward. This extreme positioning creates two possible scenarios. Either the structural dollar weakness thesis is correct, and this positioning reflects rational forward-looking assessment, in which case the dollar continues weakening and precious metals receive a sustained tailwind, or economic data comes in significantly better than the consensus expects, forcing a violent short squeeze where everyone rushing to exit their dollar short position simultaneously creates massive covering pressure that temporarily strengthens the dollar and puts pressure on metals prices. Both scenarios are possible. The extreme positioning makes the resolution violent in either direction. Ray Dalio's analysis of 500 years of empire and debt cycle data concludes that America is currently in stage 6 of 9 stages in the classic debt cycle. Stage 6 is characterized by slowing productivity growth, debt service costs rising faster than GDP growth, money supply expanded 40% since 2020, wealth concentration at century-high levels, and rival powers systematically building parallel financial infrastructure. Stage 6 does not mean immediate collapse. Howard Marks documented extensively in his work on market cycles that understanding where you are in the cycle matters far more than predicting exact timing. Stage 6 can persist for years before transitioning to Stage 7, which historically involves either massive debt restructuring through negotiation or conflict. History shows that 90% of these debt cycle resolutions have involved some form of military conflict, not because humans are inherently violent, but because the debts become mathematically impossible to service when internal inequality peaks and external rivals emerge simultaneously. This creates conditions where conflict becomes the least politically unacceptable option compared to accepting economic decline. This is the context in which China is building parallel financial infrastructure, in which the PBOC has been buying gold for 15 consecutive months, and in which Eastern physical silver premiums are running $10 above Western paper prices. China's goal, according to geopolitical and economic analysis, is not to adopt the current US-dominated financial system. China wants its own financial order with its own characteristics. Production over financial speculation, social stability over shareholder extraction, currency strength over perpetual debasement, capital flowing into the productive economy rather than being recycled through financial engineering. The American model prioritized financial profit above all other considerations. Wall Street captured the regulatory apparatus. Main Street lost the manufacturing base. The real economy was sacrificed to financial engineering over decades. China already dominates the physical economy through manufacturing capability, supply chain control, and trade volume. The current phase is about financial dominance. The Shanghai Gold Exchange premium to Western prices is not just a market inefficiency. It is the early expression of a different price discovery system establishing its own authority. Jim Rogers, who co-founded the Quantum Fund, which gained approximately 4,200% from 1973 to 1980, is delivering a very clear message to anyone paying attention. Do not sell your silver, do not sell your gold. He still owns both, has not sold any. If prices drop, he hopes he is disciplined enough to buy additional physical during those pullbacks. He bought recently during drops. His assessment is straightforward. There is a gigantic amount of money printing happening across every major economy simultaneously. Many people globally are protecting themselves from currency debasement, which historically has always included metals as core protection. This is not new. This is not a modern phenomenon. The historical proof extends back thousands of years. Physical metals have served as protection against currency debasement across every civilization that has ever practiced monetary expansion. Reports from the ground today confirm that silver is selling out in Dubai. This is not a social media rumor. Wealthy individuals in the Middle East are sophisticated buyers with professional purchasing agents operating globally. This physical buying from Middle Eastern markets is acting as a direct counterforce to the Western bullion bank paper smash attempts, because physical absorption prevents sustained downside moves when Eastern demand remains structurally strong. Silver was knocked down $2 in Asian trading at the open this morning in what appears to be a classic tactic to scare participants and create a lower accumulation price. But silver recovered as buyers in the Middle East and Europe came in on the other side. The physical bid is real, and it is active even during the Shanghai closure window. Here is the honest bearish case, because intellectual honesty is what separates genuine analysis from cheerleading. The bank holiday today creates light volume conditions that are ideal for paper manipulation attempts. Shanghai being closed until February 24th removes exactly the Eastern physical buying pressure that has been blunting the most aggressive paper raids. Historical 4.9% delivery average could hold, meaning only 29 million ounces demanded from 294 million open interest, which COMEX registered inventory at 90 million can handle without visible stress. The $20,000 gold call options are lottery tickets that expire worthless if no monetary crisis materializes. Dollar shorts at a 14-year extreme could reverse violently if economic data surprises to the upside, forcing massive mechanical covering pressure. China building parallel financial infrastructure does not translate into immediate dollar collapse. Stage 6 can persist for years. These are genuine risks. Anyone telling you the squeeze is guaranteed and the timing is certain is selling you something. Markets can remain irrational longer than participants can remain solvent. This is not investment advice. This is financial warfare education. Here is what the data is actually showing when you look beneath the surface narrative. 57% of March silver open interest has not rolled, despite being inside the normal rollover window, where historical patterns show mass exodus to the next delivery month. Recent delivery percentages running 10 to 13% versus the historical 4.9% average show elevated physical demand is a persistent trend, not a one-time anomaly. Even at historical average delivery demand with the current 294 million ounces of open interest, that is 29 million ounces against 90 million registered. Technically manageable, but it is the tightest ratio in the modern era during the 6th consecutive year of structural deficit. The Chinese silver fund investor compensation situation exposed that the SHFE daily price limits created exploitable mechanical vulnerabilities that inform players with advanced information used systematically. Asian buyers are treating every Western paper raid as a buying opportunity rather than a sell signal, creating an east-west divergence where physical price reality and paper price reality are moving in fundamentally different directions. Dollar short positioning at a 14-year extreme validates that structural concerns about reserve currency status are not fringe views, but the dominant consensus among sophisticated fund managers globally. The data is clear about the setup, even if exact outcome timing remains probabilistic rather than guaranteed. Markets do not bottom because sentiment improves on its own. They bottom when forced sellers have finished their liquidation and physical supply exhausts the paper selling pressure. Fear-driven emotional liquidation is mechanical and predictable. The physical demand underneath it is structural and persistent. 9 days to first notice day. 57% of open interest still in place. Shanghai offline for 8 days. The window is open. Use logic, not emotion, to navigate what comes next.